So without further ado, let's welcome Mitchell Rice here to this little stage.
Let's do it.
Appreciate you, brother.
Yeah, thanks.
Is this, yeah.
Can I, does that advance slides?
Yep.
Okay, perfect. Does this have a, okay, I brought my laser too so I can point. Does this, oh, that doesn't even show up. I'll just use my finger. Okay, let's see. All right, so I'm Mitchell Rice. First of all, I'm like really humbled to be in this room. All you guys are incredible people, different backgrounds, different skill sets. And I'm not going to pretend to be an expert in private equity by any means. I'm a real estate private equity person. But I know that this room is more traditional private equity, so my goal with this is to try to bridge the gap a little bit between real estate and traditional. So a little bit on my background. So I was the senior analyst for the LDS Church's for-profit commercial real estate investment arm. So it's called Property Reserve. So that's how I learned how to underwrite commercial real estate. I did it for a couple of years. So my team, we built buildings like this. I don't know if you guys have seen 95 State Street in Salt Lake. It's about a 25-story high-rise commercial office tower. If any of you have been to Riverton, this is right in front of the Costco. This is Viviano at Riverton. So it looks like a residential community, but every one of these homes are actually for rent. So we call it horizontal apartments. It's also known as build for rent. So this community is over 300 homes. You can see we put all the amenities in the center. I worked on big warehouses. This is out by the airport. This is a 500,000 square foot warehouse. You can actually fit 7 to 8 full-size NFL football fields inside this building alone. The biggest one we did was in Indiana. It was 1 million square feet. That building could fit 17 football fields. And then large self-storage complexes like this one in Honolulu, Hawaii. So I got to work on some cool projects. Average deal size was about $100 million. And that just gave me the confidence to leave and start my own real estate private equity company, which I did. Actually, before I get to that.
100 million or 100 billion?
Mine?
Yeah, million.
Oh, 100 million was the average deal size of the deals we were doing.
That sounds like billion.
Sorry, thanks for clarifying. You're like, whatever, Mitch.
Get out
Before I talk about Elkstone, so I started Elkstone Capital. I also do commercial brokerage. Have any of you guys heard of Brandon Fugel? So I'm doing a deal with Brandon right now, actually. In fact, so I'm representing Any Hour Electric, Plumbing, Heating and Air. You've probably seen their red trucks all over the road. Some of you might have seen the Crumble sign come down at Crumble's headquarters in Linden just a month ago. So we're actually in final negotiations on this building for Any Hour. I got a text from Brandon 9 minutes ago saying you need to save your clients from their own stupidity. So that's been fun, getting to work with people like that and represent big clients. I've sold bars and restaurants. I've done suburban office and medical space. I've done historic schools. I've done retail. I'm selling a couple car wash businesses right now. I've done warehouses and flex. So that's kind of the two sides of what I do. So really jumping into Elkstone Capital, as Nate said, we're up to 600 doors. And just to be very clear, I do not own that real estate. Really, it's my partners. So we go out and we syndicate the capital. So in the past 2 years, we've raised about $18 million to pretty much get us to 70 million in AUM. So my first deal was a self-storage development I did with my dad up in Idaho. My second deal was a 207-unit value-add multifamily property in Nashville. My third was so Nate and Lacey probably remember this. I presented this deal at Breakfast Palooza several years back. So it's cool to see this come full circle.
We did the video.
Because we did the video. I presented this deal before we closed, and since then we've closed. This was a hotel. We converted it to an apartment building because it's worth a lot more as an apartment. I'll explain that more later if I have time. And now we're leasing up with 12-month leases, so we're up to like 65 leases out of 109 units. As soon as we get to like 95, 100, we'll refinance. We'll pull out a couple million out of this deal and give back to our investors. And then our most recent acquisition was in Indiana. This is Gateway Crossing. I decided the last deal I wanted it to be lower risk, not so much a value add. We've actually had some struggles with this value add deal in Nashville, mostly just getting over the occupancy hump. So on this deal, I was like, I want to go buy something new, very low risk, doesn't have a big value add component. And this actually had a 3.5% assumable interest rate in place on it that we were able to assume with 7 years remaining. So it's cash flowing day one, which is pretty cool. But anyways, so to jump into our educational component, real estate P versus traditional P, they are very different, but at the end of the day, strip away the wrappers, the underlying discipline is the same. You buy cash flow, improve operations, increase income, cut expenses, manage risk, and exit intelligently. So real quick, does anybody know how real estate is valued? Have you guys heard of cap rates? So you guys know this. We've been talking about this. Businesses are valued on the EBITDA multiple formula. Commercial real estate uses the cap rate formula, and I accidentally messed this up. So this should say value equals NOI divided by cap rate. So for example, let's say you find a commercial building. It's making $1 million in net operating income per year. Let's say this is a hotel. A hotel might trade at a 12% cap rate in this market. Maybe it's a Class C extended stay brand and a little older. So you take that $1 million divided by 12%, you come up with an $8.3 million valuation. Now, let's take a multifamily project. Let's say it's making the same amount of income per year. Multifamily is viewed as way less risk because they're 12-month leases. So the income on that property can't just go to zero overnight. Like, let's say there's a pandemic, a hotel can lose its revenue overnight because they're overnight leases, essentially. An apartment cannot, so that's why it trades at a lower cap rate. So again, same income, that building's worth $15.4 million, simply because of the difference in cap rate. And then this is super interesting. So again, you guys all know that when valuing a business, it's EBITDA times the multiple for that industry. Did you guys know that so cap rate and EBITDA multiple are actually algebraic inverses of each other? So for example, let's see. Let's take a 5% cap rate, for example. If you divide 1 divided by 5%, that's the equivalent of a 20 multiple. And now flip it over here. If you take 20 divided by 1, that's a 5% cap rate. So the point I'm making to you guys is that the different valuation methods being commercial real estate and businesses, they're just algebraic inverses of each other. Does that make sense? Okay.
Can I ask you a question?
Absolutely.
Why are all those Park City homes being bought by private equity or private capital at 1% or less cap rate?
Yeah, that's a good question. So he asked, why are institutional firms buying product at such low cap rates? I haven't heard of institutional firms buying at a 1 cap. It's pretty hard to make a deal pencil at 1, but
I'm telling you, like, I'm looking at real estate up there.
Really?
They're at 1% cap rate.
That's crazy.
And some less.
Interesting.
Is it just boasting and positioning, saying we got property there?
I don't know. I honestly don't know. And apparently, according to a broker in Park City itself, 70+% is bought by capital.
Is bought by what?
By investors.
By investors. Yeah, that's interesting. Yeah, I mean.
So what I'm saying is, this is great, right? But it's insane how the cap rates have evolved.
Totally.
12.5%. I mean, that's great cap rate.
Well, yeah, and you think
For
about
an
it.
investor.
If I go buy even an apartment complex at a 5 cap, I'm paying a 20 multiple on
Yeah.
that. So real estate trades at insanely high multiples
Yeah.
compared to businesses. And why is that? It's because it's viewed as less risk.
Interesting.
That's really what it comes down to.
Or is it less supply?
That definitely plays into it as well. Utah is very supply constrained.
Because I mean, we have seen massive problems with office, right? Those were bought by 4%, 5% cap rates in Manhattan.
Right.
Now
And a lot of those have expanded to 8 caps now. So a lot of those have lost 70% of their value
Yeah.
just in the last 3 to 4 years, simply because cap rates expanded.
The point I'm trying to make is that, I mean, it's all great, and real estate is always good, right? It's like a part of a portfolio. But real estate can be as overvalued as any other company, number one.
Yep.
And number two, I think the risks are not as low as, people think.
Yeah, so we'll jump into that. Let's keep going. I actually have a slide. So we already talked about this. So let's talk about buy box for a second. So all disciplined capital allocators in any class define their target criteria, their buy box. So that's going to help you with your focus retention as you're looking for deals. And it's going to help your pre-commitment to rational decision making. So on the real estate side of things, for me, my buy box, I'm targeting a certain geography. I'm targeting certain markets. As far as asset type and vintage goes, I'm not out there trying to do every asset class possible. I've made a decision that I want to play in multifamily for the time being. I don't want to be in industrial. I don't want to be in retail. Every asset class is a little bit different. And for traditional private equity, that's the equivalent of choosing your industry, right? For me, inside of real estate, my industry is the asset class that I'm focused on. And then return thresholds, that's part of your buy box as well. We underwrite to a target IRR, equity multiple, and cash on cash. I'll cover that on the next slide. And whereas traditional, again, you need to lean into your industry strengths and knowledge. You need to define your EBITDA target. Are you trying to do a small SBA 7A loan? You know, if that's the case, you're 0 to 500K. If you're going standard, you're $1 million to $5 million. If you're lower middle market, you know, you're 5 to 10 million plus. High up is 20 million. Side, you were talking about large cap. That's 100 million plus, right? So you got to define what your EBITDA size is, and a lot of that comes down to how much capital do you have at your disposal, right? And then what's your margin floor? Do you want to be in a business with low margins, or are you going for a very high margin business? So maybe you won't look at anything less than 20% margin on profit. What's the predictability of the revenues? Are they transactional? Is it on a subscription basis? What's the concentration of revenues in your customer base? Are half of your revenues coming from your top 3 to 4 clients? Maybe that's a red flag for you, or maybe that indicates safety for you. So this is my criteria on the real estate private equity side. So I want to double my investors' money over 5 years. I want to get them an average of 7% cash on cash return per year over the hold period of the deal, which is typically 5 years. And I want to hit an 18% IRR. So I look for assets anywhere between 5 up to 30 million. For Utah, this is my specific buy box. Outside of Utah, I'll go bigger. But Utah, that's expensive. So I found I want to be in the 30 to 100 unit range. If I'm past 100 units, I'm competing with the big real estate private equity guys that are okay with a 15 IRR or a 14. So they're going to outbid me every time in the bid process with the brokers. And then if smaller than 30, now I'm competing with guys who are just buying stuff up. You know, high net worth individuals, they're going out and buying small multifamily, and they're not underwriting. They're not underwriting to cash flow. They're just looking at comps. So they're paying a high price per door that I know my deals won't pencil out. So that's why I've chosen to play in this range. So you have to consider your competition when you're considering your thesis. And then vintage, like I don't want to buy a property older than 1980 because there's a lot of issues. You know, now we're talking about a property that's over 50 years old. So every couple of years, this bar for me is going to raise. Probably in 5 years, I'm going to make that line. It's going to say 1990 instead of 1980. And then as far as like my deal process, so I want to do 2 to 3 acquisitions a year. What that looks like for me, I have to see 300 deals. I have to do a high-level review on 300. I have to choose 200 to do a back of the napkin on. Of those 200, I need to choose probably 80 to 100 to do a full underwrite on. Then of those 100, I probably need to offer on half of those. And I'm submitting LOIs at pricing which exceed my target returns. And I have to submit probably those 50 LOIs to get to, let's say, 5 deals under contract. And then I'm really only going to close on 2 to 3 of those. Because a couple of those, we're going to find something that we didn't like during due diligence, and we're going to pull out. So it's a lot. It's so much work to find your target acquisition that pencils.
What's a 7% COC return?
Cash on cash return.
Cash on cash.
So yeah, for anybody that doesn't know, internal rate of return looks at all your future cash flows over your hold period. So it includes your cash from distribution and your exit price that you get when you sell the asset. Cash on cash doesn't look at exit. It only looks at strictly cash flow.
Yield, like dividends.
Yeah, dividends.
Yearly dividend.
So if you, let's say you had an investor invest 100 grand. Let's say you invested 100 grand in one of our deals and you get back 7 grand in year one. Your year one cash on cash return is 7%. Okay. So I think we're going to skip past this just for sake of time, but again, you need to have a good thesis for why you're in the industry you are. Actually, let me run over a couple
You're
of
good.
these. So like why multifamily? There's a big housing supply shortage in a lot of markets. Like Utah, for example. Utah needs more housing. Right now, there's a home ownership affordability crisis because interest rates are so high. That means more people need to rent. Younger demographics delay home ownership. Utah, for example, has strong in-migration trends, strong population growth, and there's a lot of barriers to entry as far as building more units. We've got the Wasatch Front to our east, we've got the Great Salt Lake to our west. There's only so much developable land to build apartments. And then why hotel to multifamily conversions? These are kind of our two niches. Well, there's a severe affordability gap for low-income renters. A lot of the hotels we convert are studio units, so we're pricing those at $700 to $900, the cheapest of the cheapest units you can get on the market. That's always our goal. And a lot of these hotels, they have good bones. They're in great areas with lots of traffic, so it just makes sense to convert them into dedicated workforce housing. So I kind of talked about some of my underwriting guidelines. Also, like, let's take Utah, for example. I know for a deal to pencil right now, I have a minimum cap rate threshold, essentially. I don't want to buy anything below a 5.25 cap rate. And again, even that seems so overvalued because we just went over the example that I'm essentially buying a property at a 20 multiple. But believe it or not, if I can buy multifamily at a 5.25 or 5.5 cap in Utah, that's a good deal. A lot of owners want sub 5, 4.5, high 4s. Very hard to make that pencil. And I know that to go out and originate new debt right now, I need my cost of debt to be greater than my in-place cap rate, or I know that year one I won't have any cash flow. And that is also one of my underwriting guidelines. I want my investors to make cash flow year one. I don't want there to be no cash flow for 2 years. You're buying acquisitions for cash flow.
That's good.
And then yield on cost. So I want to be able to increase rents, cut expenses, and over the course of 12 to 24 months, I want to push this yield to a 6.5, call it. And that's, I guess, the equivalent of that to traditional PE. Let's say you buy a company at an 8 multiple, feels a little overvalued, but you recognize arbitrage and you increase income, cut expenses, and maybe looking back at your original basis and your stabilized income a year or two into the future, maybe your multiple you actually bought it at was a 6. So you essentially lowered your multiple through adding value to your business. How we find opportunity, we look for properties with financial pressure, at risk of default, maturing loans, capital calls, poor management, or the property's been neglected, operational inefficiencies. Like this especially, if I find a property that's 100% occupied, I know immediately that the rents are below market. You should always run at a 95% occupancy target. You're dancing between always pushing rents as high as you can, but staying at a healthy occupancy rate. And if you're at 100%, it means
Underpriced.
exactly. I'm going to skip this. I saw that Nate's going to talk about this in Q2, sourcing deals. I really like this slide. So value creation levers, same playbook, different vocabulary. So with real estate, raising rents, so mark to market or repositioning an asset to attract higher paying tenants, the equivalent of that for PE. Binding small businesses with legacy pricing. So a lot of legacy business owners are scared to increase prices. They have loyal customers. They don't like to raise prices. So raise prices on sticky products, loyal high value customers. In the red, reduce expenses. So for real estate, switch insurances, assess utilities. Where's their utility drag? Go appeal property taxes. Maybe the assessor has assessed you high. You could save money like that a lot. And the biggest one, renegotiate your vendor contracts. And then the equivalent in my mind for traditional PE for that is SG&A reduction. So eliminate owner discretionary spend. Saeed talked about a lot of owners write off their personal vehicles, their family cell phone plans, their country club memberships. I'm brokering a business on Idaho, and the seller right now is literally doing all of that. Every small business owner is doing that. So trim the fat, professionalize the overhead. Improve occupancy. Again, we've already talked about that. On the PE side, install management. Operator upgrades often drive the single largest value jump. But ask yourself, are employees sticky or not? If you come in and disrupt the system with a new GM and you change things drastically, are you going to lose employees? Do you care? Do you want them to go? And do you want to hire your own new team, or do you want to keep the employees in place? On the real estate side, reposition your asset. Capital investment that changes the rent profile, such as landscaping, new signage, security, etc. On the PE side, margin expansion through purchasing more equipment or improving your margin. And then optimizing financing. And then another one, bolt-ons. For anybody know what a bolt-on acquisition is in traditional PE? Nate?
Just you got it.
Buying another business to bolt on to your existing business to eliminate that competition and drive the growth for your company. This is essentially the equivalent in real estate of buying multiple properties in the same location so we can do a portfolio sale to a bigger institution when we exit that in 5 years. That's what we did with that Indiana property. My partners have a property 10 minutes up the road, 180 units. Ours is 160. So right there we have institutional scale for a big group to come in and buy us out. We'll get a lower cap rate. Identifying risk, that's something Milton brought up. What if cap rates go up? There's interest rate risk. On all of our deals, we like to do fixed rate debt. It's my understanding that SBA loans are floating. It's prime rate plus a spread. Can you get fixed rate with SBA? Or is it always floating? I think SBA 504 loans are fixed, but I believe standard SBA is floating. Is there vacancy risk? Potentially with the slow lease up or lots of evictions. Again, that's what we ran into at our Nashville property. Is there expense risk? A lot of the times you buy a new property and the tax assessors come after you and they've been assessing the value of the property here, but as soon as you buy it at the new market value, boom, your property taxes are going to jump 30 to 40% in year one. So are you underwriting that? If you have a construction component, do you have construction risk? And on the PE side, again, we already talked about customer concentration risk, key man dependency. Are revenues cyclical? Is it a cyclical industry? Is the company in growth mode? Is it going to burn through capital quickly? Is there competitive disruption? Hopefully you're the disruptor and you're implementing AI. So I think that's the key to not getting disrupted, is keeping up with that trend. And then multiple expansion through scale. The more scale you get, the higher multiple your business is going to trade at, right? So interesting chart, 0 to 500 EBITDA. You know, you might be in the 2 to 4x multiple range. 1 to 5, you might be the 4 to 6. 10 million plus, you might be 6 to 9, and that just keeps going up and up. The more EBITDA your company is producing, that's because the better well-oiled machine you become, you look more attractive to the bigger PE firms, right? So I'll take like 2 more minutes. I wanted to share just a couple things I've learned from brokering that business. It's a paint and body shop up in Idaho. Recasting earnings, we talked about this. For the first month, there was like a lot of friction with me trying to understand the financials because the owner wasn't sharing with me how he was doing write-offs. You know, I had to explain to him, look, I'm not the IRS. Like, I'm just trying to understand how much money you're making. And you're telling me you're making 650 grand a year, but I'm looking at your tax returns, and it shows you're making 250. And so we had to discover all the add backs to add to seller discretionary income earnings so I could properly convey that to buyers. And that took trust. So I think as a buyer, you have to build trust with the seller to understand what those add backs are, to construct a normalized EBITDA. And then cyclicality. So there was a large hail year in 2023. So his revenue was $4.5 million in 2023. But like that definitely wasn't the norm, as you can see. 2022, he did 2.5. So this is more of a normal growth stage. This year was also somewhat of an outlier because we had like no snow. And as a paint and body shop, his business is largely driven by insurance claims from wrecks. What happens when there's a blizzard? There were so many wrecks yesterday and the day before. Oh my gosh. I drove from Farmington to Provo. It took me 2 hours 2 days ago. So you don't want to be underwriting a business here and be paying a multiple based off this income when really this is normalized income. So if there's a big jump in revenue, you need to be asking hard questions. Like, why was there a big jump? Is this actually normal moving forward? Or was that an outlier year for some reason? Does that make sense? And then last thing, I've noticed he has a pretty good competitive moat around his business. It's in a small market, but he's one of the only 3-car simultaneous paint facilities available. So he can paint 3 cars at a time. There's only one other place in the market that can do that. He has certified direct repair programs with all the big insurance companies up there. And so that creates a lot of limited competition. So that's where I'll end with the educational piece.